In March 2020, the largest financial intervention in modern history was launched under the cover of a health emergency. The United States Congress authorized trillions in spending, while the Federal Reserve created unlimited money to protect asset prices. You are now paying higher prices every day because letting them fall would collapse the debt and asset system they chose to save. Prices are not high because of supply chains. Prices are not high because of temporary shocks. Prices are high because after 2020, governments and central banks decided that prices are no longer allowed to fall. That is the core change. Everything else follows from it. For most of modern capitalism, there was a clearing mechanism. When demand collapsed, prices fell. When prices fell, bad debt was exposed. When bad debt was exposed, it was written off. That process restored purchasing power to people who lived on wages and savings. That system punished leverage. It punished speculation. It punished institutions that took too much risk. That system ended in 2020. In March 2020, the United States Congress passed the CARES Act. It authorized $2.2 trillion in emergency spending. Within the next 18 months, total U.S. fiscal stimulus exceeded $5 trillion. At the same time, the Federal Reserve cut interest rates to zero. It launched unlimited quantitative easing. The Federal Reserve explicitly stated it would purchase assets in whatever quantity was necessary to stabilize markets. The Federal Reserve's balance sheet expanded from roughly $4.2 trillion in early 2020 to nearly $9 trillion by mid-2022. That money did not move evenly through society. It never does. New money entered through primary dealers, large banks, bond markets, and asset purchases. These institutions received liquidity before prices adjusted. They were able to buy assets before inflation showed up in consumer prices. Households received checks later. By the time that money arrived, asset prices had already moved higher. The same structure played out in Europe. The European Central Bank expanded the pandemic emergency purchase program to 1.85 trillion euros. Negative interest rates were maintained. Sovereign bond markets were fully backstopped. The official justification was crisis stabilization. The incentive was balance sheet survival. If prices had been allowed to fall after 2020, government debt would have become larger in real terms. Corporate debt would have become harder to service. Highly leveraged institutions would have failed in sequence. Pension funds would have faced immediate shortfalls. Bond markets would have frozen. Political systems would have come under stress. Falling prices were no longer viewed as a correction. They were reclassified as a systemic threat. Inflation, by contrast, was treated as manageable. Inflation reduces the real value of debt. Inflation supports nominal earnings. Inflation allows balance sheets to heal without explicit defaults. This decision created a one-way transfer of wealth. First, financial institutions and asset owners received new money. Stocks rose, real estate surged, private assets repriced upward. Balance sheets recovered through asset inflation. Second, corporations raised prices. They cited inflation publicly, but earnings reports showed margins expanding beyond cost increases in many sectors. Inflation provided cover. Pricing power became policy-enabled. Third, wages adjusted last. Labor contracts lagged behind prices. Purchasing power fell and did not recover. This is why prices feel sticky. When inflation slows, prices do not fall. They stabilize at a higher level. This is not because prices cannot fall. It is because allowing them to fall would collapse the structure that was just protected. If prices fell meaningfully today, corporate earnings would compress immediately. Equity markets would reprice downward. Pension funds dependent on asset returns would face deficits. Government debt would become harder to service in real terms. That outcome is unacceptable to incumbents, so interest rates are cut early, fiscal spending resumes, and inflation is tolerated. Purchasing power is sacrificed to preserve balance sheets. Deflation is no longer a tool. It is treated as a failure condition. This produces predictable behavior. Incumbent powers defend asset prices through monetary and fiscal intervention. They suppress real yields. They inflate away obligations. The long-term cost is currency credibility and social cohesion. Challenger nations avoid direct confrontation. They benefit from currency dilution while quietly reducing exposure. They accumulate commodities. They expand bilateral trade. They diversify reserves. Hedgers and opportunists adapt without commentary. They reduce idle cash. They exit long-term fixed income. They increase exposure to real assets and pricing power. They do not argue about inflation. They reposition. This creates two possible outcomes. If the current order holds, inflation remains structurally higher. Real wages remain suppressed. Asset owners continue to win. If the order fragments, currency blocks expand, trade becomes regional, inflation volatility increases. In both outcomes, prices do not reset downward. The clearing mechanism is gone. Long-term cash savings lose purchasing power by design. Fixed-rate bonds lock in real losses. Businesses without pricing power are structurally exposed. Single currency dependence increases risk. Expecting prices to normalize downward is no longer a strategy. Prices are not high by accident. They are high because resetting them would collapse the debt asset order built after 2008 and reinforced in 2020. The rule was broken. The mechanism is locked in. The transfer is ongoing. Next, this continues with how artificial intelligence, energy demand, and physical infrastructure are becoming the next enforced price floor, and why land, power, and metals are already being repositioned before the public notices.